The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to bring someone to the Rebel Capitalist Show that I've got a tremendous amount of respect for. He's someone that I've been following on Twitter for actually many, many years, way before I started the YouTube channel. He's a fund manager, and he writes research for big hedge funds, for family offices, and the retail investor. His name is Chris MacIntosh. Chris, welcome to the Rebel Capitalist Show.
Thank you very much. It's good to be here, George.
Now, I'm really excited to have a pro out there because you can talk to economists or other people in finance or talking heads that are popular on CNBC or Twitter, and it's not the same. They can afford to have a bias because they don't have skin in the game. But you make or lose money based on you being right in the marketplace. So you cannot have a bias whatsoever. And I know so many of my viewers, they might not understand economics, they might not have a PhD, but they see what's going on with the Fed and all this money printing and all of these 4-letter and 5-letter programs that they've set up, and it doesn't feel right to them, but they don't know why. So you're such an expert. Can you tell us why that visceral feeling they have may actually be correct, even though they don't have a PhD?
There's a lot of answers to that one question, I guess. You're correct, and I think you hit on something that's important. And this isn't even something that you need to, as you mentioned, have a PhD in economics in or anything of that respect. But that feeling, that sense of something not being quite right, is and it's pervasive across the industry, across economies, and essentially across the Western world now, where people, they're looking and they're going, this is not, A, it's not normal, and B, we can't put two and two together. We don't quite know what it should look like, but we know that this is highly unusual, and we're suspect. We're very suspect around what is taking place from governments, from central banks, and so on and so forth. And I think that's actually critical, because if we take a step back, we could go back to essentially for the last 50 years, George, we've had this stunning debt buildup, and each time it's attempted to deflate, we've had interventions of some nature. It attempted back in 16 to deflate. It was a short, mild recession, which they should have just let go, and we would have had a recession. It probably would have lasted a typical recessionary period, maybe 3 months, maybe 6 months. Hell, even if it lasted a year, it wouldn't have been a particularly devastating type of economic event. But they didn't do that, and when we went into that, we actually went into that with extremely low interest rates. And so they slashed rates again. Go back to 2008 and the GFC, that was the market trying to clear. It was trying to deflate that debt bubble. What they did there was as I'm sure you're well aware, they simply transferred those liabilities onto the public balance sheet off of the private one. But we can go back even further prior to that. There was 1997, 94, 87, 81, 74. We've had literally 50 years, and you can see it on a if you look at any of the bond yields or bond prices, pull up the 10-year, 30-year, and so across maturities, across that time frame, and across Western world. So you can take US debt, you could take European, Bank of Japan, most of the major economies around the world. You pretty much had a almost linear move, and each and every time they've tried that the markets try to deflate that debt, the central banks have come in with some sort of interventions, and this time it's not isolated to one country or even to one sector. The GFC, which everybody remembers quite clearly because it was quite a big event, and There's been a lot written about it. There's been movies made about it, and so on and so forth. That was really one sector. It was the housing sector, which then had ramifications for the financial sector and the insurance sector and so on and so forth. So there was a ripple effect in that. So not suggesting it was small or anything like that, but it was still relatively isolated. It was also isolated to the US market largely. The ripple effect in other economies was as a consequence of dollar funding, credit contraction, and things of that nature. So this time, it's global, and it's pretty much every asset class. So that's essentially, we're at that point where it's almost impossible to look at this and go, it's not really a big deal. So your average person who's not a PhD in economics or whatever, maybe they're a dentist, maybe they're a plumber, who knows? But they look at this and they're like, hang on a second, this doesn't seem right. And when you feel like something doesn't seem right and somebody else on TV is telling you it's cool, you're fine.
Right.
And you start getting that sense that you don't really trust them. And when you have that at scale, that's revolutionary stuff. So that's essentially where we're at. And when I say revolutionary, I'm not trying to be bombastic and talk about people out in the streets with pitchforks, though you may get that, but just revolutionary in terms of that zeitgeist change that you have. And when trust evaporates, which is essentially that tipping point that we're at now, there's only really two ways that you can deal with that, and one is an authoritarian measure, and the other one is stepping back and letting it clear. So yeah, that's kind of where I feel like we're at right now.
What would you say? Let me try to play devil's advocate, because I know what someone would say who is a little more mainstream, and it's not that I agree with this, but I'd like to get your feedback. They're going to say, Chris, well, listen, the Fed is going to come in. They're going to do quantitative easing. Look at 2008. Quantitative easing worked. This is what they're saying, right? It gave us this V-shaped recovery. The market came back up, all-time highs, unemployment rate at an all-time low. Before this, we'll call it a sickness because I don't want to get demonetized by YouTube. But before this black swan, we'll call it, before this happened, the American economy was jamming. We had the best economy we've ever had, and the Fed was able to step in with money printing and solve the problem to get us to the next phase of economic growth. So why can't they come in this time? And now we understand it's a little bit different, but once the sickness passes through the system, call it 2 weeks, 2 months, and the Fed sets up all of these credit lines and FX swaps and guarantees to do QE infinity, and the government, they're coming in and doing a $2 trillion stimulus package, and they're doing MMT. They're getting money into the pockets of everyday people, plus they're backstopping all of these amazing American corporations and the economy. So when we come out of this, we're going to be raging and it's off to the races.
So there's you should be on CNBC, George.
Exactly. See, just so all my viewers know, I can argue the flip side of the coin, just so you know.
There's okay. If we go back and we think about what we've had as a consequence of QE, what we've had, and there were plenty people that I know, other financial commentators and so on and so forth, who argued that QE and unlimited credit, because it wasn't going to differentiate between the actual printing of money and just credit stimulus, because they kind of have different impacts. But they argued that was going to be highly inflationary, right? And and then you've got other people who said, well, no, it's not going to be highly inflationary. There's demographics and there's so much debt, and when you have such a debt overhang, it's almost impossible to have an inflationary outbreak, and so on and so forth. But if you go back and forgetting about who was right or wrong, and we just say, okay, what are the consequences that we can now see? And what we had was a massive inflation, but into assets like stocks, bonds, and real estate,
Right.
at the same time that you had consumer goods and commodities all experiencing a deflationary period. And it's got to be careful to not sort of say, oh, well, you had this event and that caused all of these things. Going into that period, remember, we had actually pretty much just come out of a massive commodity boom, where supply was where the market was oversupplied. So 2012 was kind of like the peak in that period. So coming out of that, you had this, there was no need for additional supply of commodities. There was an oversupply anyway. It was going to be deflationary whether the Fed did. It didn't really matter what the Fed did or any central bank did. So you had the
Right.
structural setup in the market. And so it was, capital wasn't going to go there because it didn't really make sense for it to go there in the same way, because there wasn't, like, why would you supply an already oversupplied market of anything? So it went into financial assets, and so we've seen the inflation in that. But so it depends on how you structure your inflationary. If it's your typical CPI index, then you could say, fine, we've had a deflationary period. I like to just sort of step back and go, forgetting about whether you want to call it inflation or deflation, say what assets, what sectors go up and what has gone down and why, and sort of work backwards from that perspective. So to answer your question, I guess, why can't the Fed come in now, institute quantitative easing, and we, in 6 months' time or a year's time or whatever it is, we're all back to the races? Well, coming into this, we have significant structural deficits anyways in the markets, to an extent that's far greater than we had back in 2008, 1997, or any of those previous crises. So, to put it into context, we've got zero interest rates. I don't think we go below that, and I don't think we go below that because there's a consensus now among central banks that that's not going to work. And the Fed came out with saying pretty much the same thing. And look, Japan tried that. That's the what they call the last decade, and it didn't work. But if you think about what we've just had, we've got the Fed's cut last week, and with the cuts that are taking place globally by other central banks, we've got about 60% of the world's GDP is now at zero bound. To put that into some sort of perspective, during the GFC, so the 2008-2009 period, US cut rates to, what was it, 430 something basis points. This time, we've only cut about 150.
Right.
All right. So, and we don't have anywhere left to go. So and this time is bigger. This is a bigger problem. So in that respect, there's no, look, think about it like this. We cut another 100 basis points. Does that get Joey in Ohio going, hey, let's go to the movies. Let's buy that plasma? Doesn't make any difference. The car salesman in Munich, oh, the ECB just cut rates. That's it. We're off to the restaurant, honey. It doesn't have an impact.
Could it have an opposite impact in the sense that if people with savings are getting less interest on the savings, they actually spend less in the real economy?
Well, I'm not sure. There's other factors, I think, that have a greater impact on whether you spend or whether you don't spend
Okay.
in this environment. And that's um, essentially, we are emotionally driven creatures, and certainly the environment we're in now is completely macro. It is completely, it's the biggest market turning points in history have been and always will be psychological in nature.
Right.
Um, and and so we had these structural problems going into that. And one could say, well, this is just the pin that pricks that particular bubble. And I think that's true. Um, but what moves it, what has moved it, and what will move it for a decent period of time is market psychology. And so um, when it comes to how you spend that capital, it's all going to be based around fear, right?
Right.
So
Right.
and I mentioned this the other day. So the idea of handouts, as they call it, helicopter money.
Mhm.
That's I don't believe that's going to work. It'll work only insofar as people paying the absolute necessities.
Chris, when you say work, do you mean work to create inflation or work to
Work to
reduce
create
the
two
downturn?
things.
Okay.
Forget about whether they're trying to create inflation or not, but just work to restore confidence.
Okay.
Okay, and when they essentially their gauge for restoring confidence is looking at the stock and bond markets.
Right.
That's it.
Right.
Okay. Um, And I don't believe that's going to work for the simple reason that when you're fearful and you cannot see an outcome, you don't know what the price of an asset is or should be 6 months out, 12 months out, you wait, right?
Mm.
If you don't know what, like you're sitting in Medellin, let's just say for argument's sake, you wanted to buy an apartment there. Do you buy it today? Do you wait? You need to have some certainty of what that outcome could be like before you're going to be comfortable in making that decision, right? That's on the longer term purchasing side of things. So if I give you money and I give you $10,000 now, and you're really fearful around what that future looks like for pretty much any asset price, you're just going to go, I'm just going to hold this. And I'll go to cash, I'm just going to hold it. Once you have some certainty of what that outcome could be, you'll be more adventurous.
Right.
You'll be more free with your spending. And if I gave you $10,000 a month, you'd be more adventurous because you'd be like, okay, well, I have some certainty of outcome. And that's kind of where we get back to now with your question that you asked, which was, why can't the Fed just sort of fix this? Okay, so let's just say they came out and they said, I'm going to give you, as has been mentioned, potentially like $1,000 a week, every week, or a month, I think it is. Fine, okay. So you have some certainty of outcome. That could restore some confidence. The problem with that is the consequences of providing that capital are that the balance sheet is going to explode because where's it going to come from? There's no real productivity taking place, right?
Right.
If you're still sitting at home watching Netflix and you're getting $1,000 a week, it does two things. Creates incredible moral hazard for people who don't understand monetary workings because they're like, this is awesome. Why should I even go out and work? Why have I been doing that for years? I'll just sit at home and get the government to send me $1,000 a week.
Right.
Bring it on. And so it's a disincentive actually to fix the system. So productivity collapses because you're not going to go out and be productive and provide any goods. So now you've got your supply of actual goods and services contracts at the same time that your government's balance sheet explodes.
Mm.
It's literally the worst of all worlds. Also, the government balance sheet, the way that the government funds itself, one of the ways that it funds itself is through taxes. Well, guess what's happening if people aren't working? If
Yeah. Yeah.
GDP is
Tax
collapsing,
receipts
and
go down.
GDP is
Yeah.
completely tied to tax receipts.
Yeah.
So it's like having a business that just doesn't produce anything more and is borrowing money to pay the lease on the building. And it's going completely the other way. So that's essentially what happens, and that's what's taking place right now. Your point that you mentioned earlier, which was that people have the sense that something's wrong. That's that uncertainty, and that's that that trust that is on the edge. It's beginning to break. Um, and that's essentially what's holding this ball of wax together. So um, right now, there's obviously in the financial markets, there's a whole bunch of other things taking place. It's essentially just a liquidity-driven environment that we're in.
Hmm.
I kind of liken it to a car crash. You know, you're in the car crash. You can't focus on much more than right here, right
Right.
now. How do you get through this and not die? And that's essentially where you're getting redemptions, and stuff's just getting, sold at will. Um, and there's a component of credit there in that much of the world is leveraged, whether it be financial assets, real estate, bonds, you name it. And there's a contraction of credit,
Right.
which is why we've been calling for some time for a very strong dollar, um, that I think right now has the real potential to rip. And yes, I get the fact that the Fed can print money, and I get all of that. But if you understand just on the most basic level, George, if you go to a bank, normally the reserve requirements are like 10 to 1, right? So you put in $100,000 and they can leverage that into mortgages and credit instruments and all that to the factor of 10. So the reserve requirements are roughly 1 to 10. When you contract that, it goes the other way. It's very difficult to replace the 9. And that's so if you go back to like the global depression, that was essentially what you had. You had this massive contraction, of debt. This time the debt is so extreme. We've got a roughly 206, nearly 260 trillion of global debt.
How much of that
If we
is
have that,
USD?
most of it,
Okay.
most of it, in some shape or form, there's swaps and things of that nature. And that's also where that gets to my point of the dollar will be strong. I'm not saying that the dollar would be stronger than other assets, but if you stick in the fiat world, to people who say to me, who are like bearish dollars, and they're like, you got to get out of dollars, you got to get out of dollars, the dollar's going to die. Get out of the dollar index. I turn around and I say to them, why are you so bullish on the euro? And then they'll
Right.
look at me like, what do you mean? Well, the euro is roughly half the dollar index. So
Right.
if you short the dollar index, you basically long the euro. And
Yeah. Right.
I mean, I could spend a lot of time on the euro, but that's a disaster. So
Yeah.
so that's really what it comes down to. And there's a lot of dollar bashing that goes on, but structurally, um, I think it's dangerous to be short the dollar. If you understand those capital flows and you understand how creditors, we look, everybody needs dollars because dollars is what is used in the global financial system, whether we like it or not. That's going to be the case for the foreseeable future, shortish term. Out of the remnants of whatever takes place, we will have to find something else. And none of us know what that looks like. But in the here and now, um, we have what we have. The system that's been built is the system that we have, um, and it simply means that we have massive credit contraction, which is very, very bullish for the dollar. And to try and replace that credit contraction, which the Fed will try and do, is almost I think it's insurmountable.
Yeah.
So the dollar
So
just
to
rips higher.
unpack that a bit here, because it once this is inflation and the dollar strength or weakness, I think is probably one of the key things that people just don't understand. And so let me kind of try to unpack it, like I said, a little bit further. So your point is that yes, the Fed is going to print up this money. Yes, they're going to do MMT into the system, but the whole entire global dollar marketplace is going to destroy dollars faster than the Fed can create dollars, and not just create them because okay, it's one thing to just say, bam, here's $250 in the reserve accounts of like a primary dealer. But people have to understand that just because the Fed prints money, it isn't necessarily real money. You've got to distinguish between the reserves that the Fed prints and puts into the accounts of the banks who are under their umbrella, and then the deposits of dollars that are out in the real economy. Those are two completely separate things. So that's kind of your point there. And I know you're good buddies with Brent Johnson, who I just interviewed, and you guys really see things the same way here. And I know you talked to Brent, you talked to Raoul Pal, you talked to all those guys that seem to be in the dollar. I'm not going to say they're dollar bulls, because fundamentally, I think none of them are really bullish. They just think that it's going to go up in relation to other currencies. So, but so hopefully I'm seeing that correctly. If I am, how do we compartmentalize as just the average Joe? They say, okay, Chris, I get it. The DXY is going to 120 because you don't like the euro, and there's going to be dollar destruction outside of the United States. But I go to Whole Foods every day, and the produce that I buy is going up in price. My health care is going up in price. My rent is going up in price. Everything I buy on a daily basis is going up in price, but you're telling me that the dollar is strong. How do we connect those dots for the average Joe?
I think to try and keep it as simple as possible, we have a fiat system around the world, fiat currency system. And that fiat currency system has been, like I said, for the last 50 years, built on ever-increasing debt.
Right.
Okay. And that debt component has leveraged the system. It's created inflation. We didn't know where that inflation would go, or the central banks didn't know where that inflation would go. Largely, it's gone into the financial assets. And one of the reasons that it would go into financial assets is because financial assets themselves can be leveraged. So you get leverage on leverage, which gets ever higher returns. And the people that have understood that mechanism have been the ones that have benefited. And as a consequence, and this is on a societal level, forget about all the money side of things. What it's meant, and we've seen this, is that income gap or wealth equality gap has been diverging more and more, to the extent now where you have fewer people with much more of the wealth and much more people with not very much. And if we go back in history, that rarely ends well.
Right.
It's fair to say. And you're in South America, and there's plenty of examples in the history of South America as elsewhere in the world. And I think that's something that's very important to understand in terms of just societies, because this goes a lot deeper than just where do you put your money. It's where it's safe and what is coming in society and how do you protect yourself from that. So, but back to your point that you're making, and this is exactly what we've been talking about, which is, and one of the things, George, that we were calling for before this Wuhan zombie flu came and knocked on our doors was this trend towards a deglobalization, and that was as a consequence partly of the wealth inequality gap, partly as a consequence that energy components around the world had changed, so that the US was energy dependent or perceived to be energy dependent. That's a different ball of wax we'll talk about with shale. But all of those structural changes have meant that the benefits of globalization have kind of reached their peak, or have seemed to be reached their peak. And I'm not going to argue for it or against it. What I think doesn't matter. It's what we're seeing. And so we sort of started seeing those trends, and it was a rise of nationalism. I wrote an article, should it be probably 2 years ago, where I was talking, it was before Trump came in, and I said, look, here's the reasons why he's going to win. And we looked at a number of other countries, the Philippines and all over the place. And I was like, these are the trends that you're seeing, and this is why the underlying trends are in place, and I don't see them going away. And those trends were all anti-globalization. And so globalization created a massive deflationary environment because you could decrease your OPEX significantly on many, many goods because you were tapping into global supply chains, which at scale, it was just scale of economies, but to an extent the world had never really experienced before, and tapping into massive labor force pools that were prepared to work for like $1 a day sort of thing, whether it be China, Bangladesh, a lot in Southeast Asia, and so on and so forth. And so that allowed for essentially that deflationary period. So forget about Whole Foods, but when you would go to buy yourself an iPhone or a plasma TV or a pretty much any technological good or even manufactured good, whether it's a table or a chair. I mean, the chair I'm sitting on now, probably the desk, is like it's all been manufactured outside of the borders of the country that I'm sitting in. And those are deflationary forces. And when I started seeing those changing and the structure for that changing, at the same time that all of the debt that allowed that to be leveraged was coming to this end. Again, you come back to the Fed, like the Fed can take this down, take rates lower, but how much lower? And so what we're moving towards, what we believed we were going to be moving towards, was a period of stagflation, which is just a stagnant, shitty economy with high inflation. But when I say high inflation, it's inflation typically in goods and services that are unfortunately critical to your everyday life. It's your foodstuffs, it's your health care, it's all of that. It's not the pen you've got or the cell phone or the anything like that. And so part of that is also because during this period the capital hasn't gone into that, so we've actually got the supply destruction in many of those goods. If you go back and you think about trying to finance anything in food production, anything in resource extraction, anything in even something like shipping, so logistics, it's been impossible. Like nobody would finance it. So there's been capital has just fled that sector. And there was just this belief that it would kind of keep going. Now we're in a period where it's literally, I mean, what this virus has done is accelerate deglobalization like that.
Right.
And so we believe that we're going to, like at the moment we're sort of in this fog of uncertainty. Everyone's like scrambling for liquidity. I know pension, like all the fund guys I talk to, like it's redemption time. Redemption times means you sell. Like, if you're invested with me and you call me up, you go, Chris, get me out, and I got to get you out. I just sell indiscriminately. Right. Also, I'm going to sell what's liquid first because I can. Not necessarily what I don't want to own. I just sell what's liquid. And so that's the period that we're in now. No one's worried about tomorrow. We're still in the car crash. Tomorrow, and I don't know when tomorrow is, that's when things settle down and people start looking around, surveying the carnage, and then saying balance sheets matter. And so when balance sheets begin to matter, you couple that with this zeitgeist that we have, where people are looking around going, this doesn't feel so good, doesn't feel right. I'm not sure, like I don't know much about the Fed, or don't know much about anything, but things don't seem that right to me. And we've got the supply destruction of I wouldn't say it's not consumer goods, but it's foodstuffs, for example. That's when people start questioning. And there's absolutely no reason that you would want to go into something like a government bond when your food prices are going up 10% a year or something like
Right.
that. Um, and so that whole deflationary impact gets called into question. At the same time, that the governments are just doing everything they can to try and mitigate that.
Yeah.
You mentioned MMT. I think that's the I think that's the probable. I hate to use the word solution.
Mm.
Um, the
What's
probable
going to be better?
outcome. I don't really see another way out of it. I mean, uh,
Yeah, as
it's
far as when you're trying to game
yeah.
theorize and trying to
Um,
figure out, okay, what's the Fed going to do? What's Trump going to do? What's the, say there's a new president, what are they going to do? And it all kind of comes back to that one point. So, well, kind of that's what's most obvious. So, what we have here is this global destruction of dollars. It increases the demand outside of the United States for dollars. We could see demand in financial markets for dollars increase, while at the same time, we could see prices of goods and services on things that you buy daily actually go up. And you could potentially see other goods and services go up because of the supply chain disruption and because of deglobalization, where more things are being created in the United States, which, oh, by the way, creates more dollar demand outside the United States because we're no longer exporting those green pieces of paper and because we're not importing anything. So it's this, and if I'm confusing people, it's because there's no simple way to just make this cut and dry. We're dealing with a Rubik's cube here that's like 6 dimensions, trying to figure out what on earth is happening. So what I'd like to do next is, I'm sure every viewer and listener right now is saying, okay, George has this amazing fund manager that talks to all these super smart guys on a daily basis, and he's just an extremely intelligent guy. He's been doing this. He's been running his own money and other people's money for a long, long time. So, what are you looking at in the world as far as opportunities to actually make money?
so, like I said, in the short term, it's a matter of understanding that liquidity is the only thing that matters. And in that environment, it's dollars. Um, so we're long dollars. There's other little trades around it. We're long tankers
Yeah,
as a
explain that one.
consequence of all the.
That's a very interesting play there. Like, so number one, could you explain that a little bit further, like why you're bullish and why you see it as an opportunity, and then how someone might play that? Can you explain that? Because I think that was really unique.
Sure. It's so. Firstly, we had massive demand destruction in the energy markets in oil as a consequence of the virus. That allowed, and look, shale was going to go away anyway, but that just put a put them in a much more difficult situation. They had a
Yeah.
wall of debt that's coming 2022, and it's if you look at their bonds, they were. I mean, we've been talking about this for ages, saying these guys, it's a disaster. Shales never, as an industry, actually produced a profit.
Right.
So, and then it comes back to the whole, hey, the US believes that they're self-sufficient in energy. Yes, sort of, but at a loss, which is then to say that they're not really self-sufficient in the global economy. Nevertheless, they believe they are. That's also created a whole lot of different geopolitical happenings. But back to the oil thing, shale was always going to have issues. It was continuously having issues. Then this oil thing hit, and what happened was the Russians, who've de-dollarized their economy, um, built up massive reserves in gold, who now basically don't really give a shit about the ruble because they can take that cushion, that take the ruble cushion, and let their currency decline, and just keep pumping oil. They looked at it. That's why they basically broke up OPEC Plus and said, "The hell with this. We're just gonna pump." Now there's other reasons I guess we could argue why they didn't want to cut supply, and that was also because Russian oil is not quite the same as say Saudi oil. You can't just shut down their production. half of this stuff is in inhospitable environments whereby
Right.
if they shut it down, it basically ices over and it can take them up to 18 months to get it back up into production. So they can't just turn it on and turn it off. It's very costly. So they have to keep it going anyway. So that's another sort of, side thing with the oil market. But basically they looked at this and said, okay, we've got this opportunity in front of us and we're going to really gain market share and we're going to take these shale players out of the business. Because they've been, the big kid on the block over the last decade. They have, been the swing player. And so the Russians, and that was never good for Russia. So they've seen this opportunity and said, okay, we can do this now. We've de-dollarized our economy. We've got a strong balance sheet. We're just going to give it to them now. They're on the ground. They're on their knees. Let's kick them in the guts. And so they went and they've just increased production. The Saudis, who wanted to cut, basically had an option. They were like, okay, we either cut and it's not really that meaningful, or we do the same thing and we together with the Russians gain extra market share, or at least remain or retain the market share that they've got. And so the world's now in this weird situation where we've got demands going off a cliff and supply is just going through the roof.
Right.
And then, of course, Donald Trump turned around and said, "What the hell with you guys? We're going to just keep up production. I'm going to support the shale industry." So it's a bit like three kids bullies in the playground all fighting with each other, and they're all like, none of it makes economic sense. But what it means is that it's anywhere from 1 billion to 2 billion barrels of oil that's going to come onto the market over the next 6 months. Into a market that doesn't have anywhere near the demand that it had before. Everybody's sitting at home watching Netflix. No one's using gasoline. And so then the question is, where does all that oil go? Most of the above ground reserves are already taken up. Trump said he's going to fill the strategic reserve with, I think it's 74 or 77 million barrels. That's going to be filled like within a couple of months. Then where does it go? You stick it on a tanker. That's what you do. So all the big
you
boys
literally store the physical oil on a tanker out just floating around.
Sure. And so the big boys like the Glencores and all the big oil traders, they'll be doing that now, and they can make a ton of money out of it because they can buy future delivery, or they can sell future delivery into the market now and buy spot, which is lower because it's in contango, and pocket the difference. It's a completely risk-free trade for them. The only cost to doing that trade is storing the bloody oil for 6, 12 months, 24 months, depending on what future they sell it at. So they're going to do that, and they're going to do that all day long because it's just free money. You're literally booking the trade. You're going, okay, sold to you on the
spot price.
Let's just say it's 12 months out. Bought at spot here. What's the difference? At the moment, we're like running about $11, or and so you can do that on freaking I think you get.
So that people understand, so the futures price of oil is about $10 to $11 higher than the spot price of oil. So if you can buy right now at spot and then immediately sell a future that's delivered, let's say in a year, and then it costs you only $5 to store it over the year, and you just pocket the arbitrage free money.
Yeah, I mean, it depends on the duration. There's different durations and different prices, but the point is that structural market exists.
Okay.
And then the cost is just storing it. So you just lease a tanker, stick it on the tanker, and walk away. Trade done. But a lot of that capital, most of it actually goes to the tanker. So and look, it's good for the trader. Let's say you make $20 million in the trade, you'll probably still keep about 20% of that trade.
Right.
But it's risk-free. It's literally risk-free. So like the tanker guy, he's still got to look after his tanker and everything. But the point is, those guys, and we're going into this market where if you pull up all of the shipping stocks, tankers in particular, they've been decimated for the last decade. structurally, you wanted to be long that sector without this particular oil market setup. Just because there's been so much supply destruction. I mean, the shipyards have been shut. Most of the guys that actually finance shipping have gone away. I challenge people to go out there and find me analysts that are covering the shipping sector. They basically all went away. So like we had a structural setup where that market was a market you basically wanted to be long regardless. And now you got this taking place. All the stuff that those tankers were used for before, it's like they're just coming off the market. So the supply is currently getting reduced more and more. And there's more, they're still pumping. So those rates, no one's really looking at it right now, but 12 months out, these stocks are going to be flying.
Are those stocks USD denominated, or are they on a different exchange? Or
there's different stocks. I mean, there's a whole bunch on the New York Stock Exchange.
Okay.
I mean, you could buy Scorpio, TNK.
So it's possible to do, if you're a USD investor, it's possible to execute that while not taking any currency risk. Yeah. Okay.
Yeah.
All right. Well, that's awesome. I mean, I never would have thought about something like that. So what else you got, Chris? That was a good one.
Term, everyone's focused on the here and now as to how to get through this. I like to kind of look 6 months out, 12 months out, and say, okay, what does the world look like there, and what are the consequences to the things that are taking place now? Yeah. And in that environment, my belief is, and this is based on a number of different metrics, my belief is that we're going rapidly into a stagflationary environment. And
right.
And in it's really, I hate it. I hate to say it, but it's the worst of all worlds. It's like getting herpes and gonorrhea all at once. It's just fucking horrible. I imagine. Never tried it, but so and because you've got on the one hand, it's what you were saying before, George, where you go to Whole Foods and the cost of your groceries are just higher every day, and yet your wages are not going up, and the unemployment rate's rising. Part of fixing that problem is just the fact we have this enormous debt buildup, and that then gets you into the question of how do governments deal with this. And I think there's been a lot talked about with modern MMT, which is just this. People say it's sort of a radical idea. I mean, it's not all that radical, I don't think. It's the idea that governments can just pump money, from the central bank basically directly into the wallets of consumers instead of into the banks. It's kind of really what I'm simplifying it, and so for those of you who follow this stuff, don't beat me up on it. It's a little bit more complex, but that's kind of the simplified version, right? So in theory, that sounds like it's a win for the people, but what you get with that is massive consumer price inflation, because you're just directing the capital flow. So remember, what the central banks have done previously was direct the capital into the banks, and the banks, because they can leverage it, would direct the capital into the financial markets, into the bond markets. Right. And so by changing the flow, it's almost like having a hose pipe and just angling it somewhere else. By changing that flow, you change where that inflation goes. The very idea that we've not had inflation, I think, is misguided. We've had inflation, we've had it in different asset classes, and we've had deflation, we've had it in different asset classes. So like when people say to me, are we going to get deflation or inflation? I say to them, in what? I like to not even think about that, but to say, okay, look at it in terms of asset classes. Where's their supply? Where's their demand? And what's going to happen in that? It's fair to say that we could look at financial assets and say, I think we're in for a deflationary period. And people might then go, oh, that's deflation. I don't really care whether you call it deflation or inflation. The asset classes that I believe will do well will be different asset classes, and so that's sort of how we're positioning now, because everything's being sold. It's just a yard sale. It's like everything gets sold. No one's looking out 6, 12 months. Um, and I think what is taking place now is simply going to exacerbate basically much of the portfolio that we have for our clients, um, that we've been building, um, because you have supply chains have been disrupted. The idea that we're going to automatically turn them back on, um, I am not sure that's going to take place to the extent that people would wish it to be. And B, when it does get turned on, there's going to be a certain percentage of it where people rethink what that should look like. Where do you get those parts from? Where do you get those supplies from? Is there's a risk reward trade-off. One of the things I'm looking at is 3D printing, for example, and I'll give you a quick, analogy here,
Yeah.
because I think it paints the broader picture.
Yeah.
If if your supply chains just broke as they've broken, okay, and coming out of this, we're going to have nationalization of resources by governments, and we're going to have trade embargoes and things of that nature. We're already seeing it. For example, India just came out and said, hang on a second, we're not going to sell these pharmaceuticals that we used to sell because we need them for our own customers who are about to experience this epidemic. And India, together with China, produced like 90% of the world's pharmaceuticals. So now other countries are realizing their vulnerabilities, and they're realizing the downside, particularly to globalization. They're realizing the risks that you take on that weren't seen until now. When you see that taking place, and it'll take place in multiple different sectors, you try and de-risk. It's no longer necessarily a pure economic equation that you solve, where you say, you know what, I could get X part from Bangladesh for 5 cents a widget, and I can, and if I did it locally, it's 6 cents a widget. Previously, it was like, okay, 5 cents it is, done. That starts getting rethought as as we come out of this. And I think in that environment, 3D printing as one particular technology has the potential to really take off. So it's sort of a side bet on it, but essentially that deglobalization, there's a number of different industries that will benefit and those that won't. But in that environment, what happens essentially is the cost of manufacturing that widget just goes up. It's that simple. And so when you go to the store to buy it, it just costs more. It's that simple, because the calculations made and the strategic decisions by business owners made to bring that to market change. So that's stagflation, and that'll be taking place across multiple sectors. And then that's without, George, even considering the whole monetary side of things, where while that's taking place, governments are going to try and figure out how the hell they're going to fix this debt problem, and trying to soak up all of that massive credit contraction, which they're doing. I mean, the Fed's just come out and said they're going to do 6 trillion over the next 9 months.
Yeah, it's astronomical, and then and that's not including the stimulus that the government is doing as well. But I guarantee you right now, Chris, everyone's loving this conversation, but they're still having a hard time understanding how you're saying we're going to experience stagflation while at the same time you're very bullish on the dollar. It's really going to be
I'm bullish. So look, as long as we're in a fiat currency system, the dollar is going to be king until it's not king. Right now, most of the world's trade is still done in dollars. A lot of debt is as a consequence of that trade being done in dollars. A lot of that debt is in dollars. That's all contracting. That's just dollar bullish. Like it or lump it, that's the way it is.
That's because you're comparing the dollar against other currencies. But when you compare the dollar to goods and services, you can have two opposite things happening at the exact same time. And that's what I'm trying to get people to understand, because I think it's a very it's a new concept because people just look at it as binary. Like we look at the 70s, okay, we had stagflation, therefore the dollar was weak. But what we don't do is we don't look at times when you didn't have that relationship. As an example, we had, and you can correct me if I'm wrong, but I think 2011-ish or 12-ish, the dollar got down to, call it 70 on the DXY. And since it's been at 70 on the DXY, now we're up to 101. But no one, the average Joe, wouldn't say that the cost of what they buy on a daily basis has actually gone down during that period, but the value of the dollar has been quote unquote strong. So I just, again, I want to hammer that home.
This is much easier for non-Americans to understand because we all live in a dollar-denominated world. But if you're you know, a Thai, a South African, a Australian, you know, people can relatively easily conceive of this environment where you can have their currency, you know, going up, and still also having an inflationary period with respect to, say, you know, copper or whatever it is, because it happens all the time. For Americans, they struggle to deal with that because their inverse relationship is almost always held. And so, you know, it's like gold up, dollar down, and vice versa. And same thing with oil. And
it's a brilliant analogy. If people could somehow look at the dollar in the United States as a completely separate currency, as the dollar outside of the United States, it would really,
all you need to do, George,
make more sense.
You just, like, what I'd suggest to people to do is take any asset class that they're looking at, and then go and price it in a number of different currencies. And you'll get this visual, like you'll get the visual of what the rest of the world is pricing that particular asset as. And so you could look at it in yen, in euros, in Thai baht, in Norwegian kroner, and you'll get a pretty good understanding across a number of different countries as to kind of what that particular asset looks like. And then you can price it in dollars, and it might look quite different. And that's your anomaly. And there could be a number of reasons why that's the case, you know. But I think that's a good starting point for people to start getting their head around what that looks like, because I think what's coming is that very environment. The dollar's not going to matter in the same way. And you can have, you know, so we can quite conceivably have the dollar going up and gold going up for different reasons. The dollar is just, you're getting this massive credit contraction. Look, it's not about what do you want to own. It's like if your trade is done in dollars and I've got to settle a contract and I need those dollars, I've got to go out into the market and I've got to sell whatever currency I have, and I've got to buy dollars to settle my contract. End of story.
Mm-hmm.
That's a separate argument or separate decision-making process to, do I want to protect my capital? Should I buy gold, silver, platinum, palladium, like hogs, whatever the hell you want? It's a separate thing. So, and I could be allocating capital towards any of those particular asset classes, and they can be going up relative to the dollar, or even maybe down. Doesn't really matter. They're separate things. So I think people need to kind of segregate those
Sure.
points, and because we will go through this, I believe, this period where we're going to have this, they've got to solve that credit contraction issue somehow. And that's going to be dollar explosive. Also, there's a feedback loop that takes place there, right? So come back to the oil market, and I wrote about this in article to clients the other day. With the Saudis printing or pumping, with the Russians pumping, with shale pumping, it's going to put out of business all the guys that can't, like all the players who can't punch in that game, they're just going to step out. And if you look at a number of them, they're dollar-pegged currencies, Oman, Qatar, like you've got a number of these players in that market who can't compete. They're going to try and pump, but at the end of the day, their cost of production is too high. And
Mm.
you'll see how long they can play that game because their FX reserves will tell you how long they
So
can play that
it
game.
breaks the peg.
Breaks the peg. Once one breaks, you get another feedback because now you need even more dollars. And I'm not going to say it's going to happen, but if there was ever a time where the probability of this taking place was the highest I've ever seen, it's now.
Mm.
It's now. So there is the real potential that we have this rip in, and it's separate from the whole argument of the Fed's printing dollars and you gotta buy gold and like go and yell from the rooftops about that, like whatever. I get it all, but it's a separate decision-making process, and so that's sort of this environment that we're in now. Longer term, again, we're just very much focused on that stagflationary type of environment, and how those structural problems get solved. I'm leaning towards the MMT type of scenario, only because
Yeah,
the default, it's either MMT or it's a default of debt.
right.
And if you think about central bankers or humans fight. We look in our rearview mirror and we fight the last war because we look at that and we go, we're not doing that again, right? We're going to make sure we don't do whatever it is. We learn from that last experience. The last major experience like this was 1929, which was the biggest deflationary period of human history.
Mm-hmm.
And my bet is that they're not going to want to let that happen.
Right.
So they're going to go down the MMT path, um,
So
which,
how do you invest around that? Like you say, stagflation and potentially pegs breaking across the world. And I know the Hong Kong peg might be very vulnerable as well now. So how does the average person size that up, and what industries do they potentially look at for some opportunity, like the shipping thing? I mean, gold, Bitcoin, or do you
yeah,
think
so
outside the box more than that?
so the system's breaking right now, and that's a big deal. What comes out of that system, we don't know. It makes a lot of sense to me. We've basically got a trust system that's no longer trusted. When
Right.
you think about Bitcoin, Bitcoin was built for this. It was forged in the financial crisis, and it was designed for this. I mean, that it's whether it succeeds or not, I don't know. But on a somewhat speculative basis, um, it makes a lot of sense to me.
Mm-hmm.
Um, there's a number of things where it's possible that it gets outlawed or something of that nature, but on a pure design basis, it is designed for this. I'm
Mm-hmm.
I'm very bullish on it, with the caveats that um, there is the potential that something comes along which changes or stops people investing in, whether it's governments coming in or not. And to understand that side of things, if you just consider how quickly the world has changed in the last couple of weeks, I'm
Right.
sitting here in a country which is basically empty, um, has had huge freedoms, New Zealand, and within the space of a few days, we went from, oh, we've got a problem, we're gonna, we want people to self-quarantine if they've traveled in from overseas, to a state of emergency where the police are on the streets and telling people to get indoors if they come out.
Mm, yeah,
And
same thing
and
here.
and so when you think about how quickly that can change, you know, the Bitcoin enthusiasts say, well, you can't stop it. And I agree, you can't fundamentally stop it. It's a decentralized process. But you can stop people doing anything. If you put a
Right.
gun at their head. I've traveled throughout Africa. I lived in Africa. You can pretty much do whatever the frick you please if you have power, and people will follow. so that's my only, I guess, hesitance against Bitcoin or anything like that. That being said, I'm wildly bullish
Yeah,
because it
right.
is literally designed for this. So that just means you position size accordingly.
Yeah.
Um,
So what about
but
gold?
and gold is, we've been bullish gold. We were showing clients before, well, it was like sort of September last year. We were showing again. You look at gold in all these different currencies. Gold was breaking out. It was telling us something way before, and it just hadn't really moved that much in the dollar. And we were saying, look at this, look over here, look here. And then
Yeah.
again, it comes back to those structural problems with the dollar, which is why the dollar's been strong. But they're sort of masking this overall move in gold.
Yeah.
Um, it's important not to just be myopic with respect to your own currency if it happens to be the dollar. Um, to look at all these other asset classes to see whether there's something happening that you're not quite aware of. But back to your question, you're saying how are we positioning it? Um, Largely, it's hard assets and it's value over growth. What I
Right.
mean by value over growth is, we're going to come out of this chaos when we crawl out of the car wreckage. That's when balance sheets are going to matter. That's when solvency is going to matter. And when we climb out of that car wreckage, we're going to also be in an environment where there will be more wreckages because the impact that is going to take place and is already taking place in the economy by shutting down business. I don't quite think people fully understand how dramatic that's going to be. If you take, I was just looking at a survey done here locally I think it was 27%, no, it was 60% of small SMEs have 27 days that they could last
Oh,
with
yeah.
no income.
Yeah.
Okay, 27 days. We're currently on a lockdown for 4 weeks.
Yeah.
Now, to a certain extent, New Zealand doesn't matter. No people here. Forget about us. But look at look at this is taking place across Europe, across the US. People are still focused on the here and now. Like, think about what that looks like in 4 weeks, 6 weeks, 6 months, and the flow-on effect. People are calling for a V-shaped recovery. I'm not sure they're looking at the numbers and thinking this through. The one thing I'm about 100% sure of is that this won't be a V-shaped recovery. Um, and in that environment, it's a massive contraction of productivity and supply of goods. And ironically, if you go back, I mean, all the stuff that we've been looking at for the last few, years have been these decimated sectors whereby there's no capital, little capital investments into them. Um, Valuations are extremely cheap, and now they just got cheaper, but they're also critical to society. I could point
Right.
to coal. Coal's a good one. Okay, so coal, there's part of it's been the whole climate hysteria, that we're all going to die in 12 years' time, according to Cortez and Greta and her crowd are all telling us to become vegans and ride bicycles and whatnot. And coal is like the devil in that whole component. But if you go back and you look at just history, like we've never gone from a more energy dense resource to a less energy dense resource. And that's
Right.
what they're asking us to do. That's what they're saying we're going to do. It's going to be wind and solar. And I look at that and I say, maybe, but that would be the first time in mankind's entire history that we would have done that. Secondly, even if that did happen, if we look at the energy sources that we've utilized over the course of mankind's history, we've actually never replaced. We've only added capacity. So when
Right.
we went from wood to coal, we didn't actually get rid of wood. We still consumed wood. We still today consume wood as an energy source. when we went from coal to natty gas and oil and nuclear, we didn't get rid of coal. We just, as a component, we use much, much more natty gas as a component of the energy, overall aggregate energy structure than coal. But the actual total coal usage has actually gone up. We use more today than back when coal was the one energy source or the main energy source. So we add capacity, right?
Right.
We don't think about your phone, George. Like, we used to just text each other. That was cool, and have a phone call. Now we'll do video calls. You'll like, you needed more capacity. So as you got more capacity with your phone, you just found shit to, like, suddenly it was cool to watch Asians falling off of motorbikes on your phone.
Right.
Right. And before, you never did that. So we just find uses, and energy is no different. So in that space, when you look at coal's been decimated. Nobody wants to know about it. We got companies that are trading for like 2 times net revenue with no debt. They're printing money. They could buy back, not via debt, which is what, corporate America has been doing, which is borrowing cheap capital, buy back debt in order to cash in options and buy a house in Malibu. But these are companies that can use profits, cash flows, to buy back all of their debt and 100% own their stock. And they're printing money, paying out dividends in the teens, and nobody wants to know them.
Jeez.
So,
they're domiciled in the U.S. or in like
some of them are. Some of them are. I mean, yeah, you can look. People just go and buy coal, the ETF, and go through the companies in that, and there's a whole bunch in there. There's others, but I guess the point I'm trying to make is that that's critical baseload energy. It's critical to survival for mankind, right? It's one of the last things we're going to turn off is the electricity.
Right.
So in that stagflationary type of environment, you've got a lot of protection with something like that, because it's not going to zero, right? It's not like a Tesla hopeful that may, make it to Mars or some bullshit like that. It's we're going back to simpler times, if you will, is my belief. And even if I'm wrong, when I look at the valuations on all of these, what I'd call value over growth stocks, they've been so cheap even before going into this, and now they're even cheaper still. And so that's that stage where you come out of the car wreck and you survey the scenery and you go, oh shit, balance sheets matter, solvency matters. Like, what matters? Oh, what matters is going to the grocery store and making sure they can put food on the table. What are the components of that? What does that world look like? And so, and that's without even looking at the whole MMT and God knows what else that they throw at us. And we'll have to navigate that as we come. But the first step, I think, that people should think about is, it's not even about trying to make money. It's about how do you protect your downside first and foremost. People are going to come out of this completely scarred. They're going to want return of capital. Return on capital is going to be something that is just, they won't even think about that. Ironically, it will probably be return on capital that you'll get in phenomenal numbers if we position this right. That's our belief and our hope. But that's the way we're thinking.
Yeah, that's incredible, Chris. So I want to be cognizant of your time. I've got about 100 more questions here that I could I'd love to ask you, but we'll have to save that for next time. So I want to let people know that I spoke to some of your the guys that work for you, and they are giving us a great deal for the people who are viewers of mine or listeners on the podcast that might want to not only learn more about what you do, but maybe get some of that research that you have for institutional investors, family offices, and retail investors. So we've done an affiliate deal with you. You guys are just really generous in your offer for my listeners and viewers. And guys, if you want to find out more about how you can take advantage of that opportunity, I'm going to put a link in the description below this video. And we're also going to have a little page allocated on our website. So that's georgegammon.com. Go under suggested resources, I believe is the tab, and then click newsletters, and you'll find out more about it. But I'd really encourage you to go to that link and check out what Chris is doing, because obviously he really knows his stuff, and he's got a way of analyzing what's going on with the macro and then connecting the dots and then finding opportunities that are way outside the box that are really, really interesting. I love the shipping idea. I love the coal idea. And I'm going to look into that tonight as soon as we get off the call. So anyway, Chris, is there another place where they can find out more about you, Twitter or anything like that?
At CapitalistEXP is Twitter handle. Otherwise, capitalistexploits.com or .at. And for our asset management company, it's glenorchycapital.net. And so that's where we run private accounts for clients. Okay. And so some people, they don't want to get too involved, or it's a lot to take in trying to manage their own capital, and they're interested in having managed stuff. So that's what we do there. But that's where you can find me.
And then the monthly newsletter you do for clients is called Insider, correct?
Correct, yeah. But if you go to capitalistexploits.com, then on there you can click on services, and that's where Insider is, yeah. Yeah,
or click on the link in the description, and you can check out the affiliate deal that we have that Lucas was nice enough to give us, and it's an awesome discount on that newsletter. So we'll leave it there. Chris, I cannot wait to do this again. I thank you for your time.
Until next time, mate. Take care. Be safe.